What's up, everyone, and welcome to the weekly edition of Sustainability Now, where we cover how the environment, our society, and corporate governance affects and are affected by our economy. I'm your host, Mike Disabato, and this week we look at our new tool that measures biodiversity risk for companies. Thanks as always for joining us. Stay tuned. When it comes to the environment, carbon emissions and weather are usually in the spotlight when we talk about financial impact. And there are a couple of reasons for that. Regulation, or very noticeable effects in weather, and the relative ease of measurement. I know what a hurricane looks like. I pretend to know what the chemical compound for carbon dioxide is and what it means. Let's compare that to the definition that the WWF has of biodiversity. Biodiversity is all the different kinds of life you'll find in one area, the variety of animals, plants, fungi, and even microorganisms like bacteria that make up our natural world. Each of these species and organisms work together in ecosystems like an intricate web to maintain balance and support life. Biodiversity supports everything in nature that we need to survive: food, clean water, medicine, and shelter. Now, if the word everything is included in the definition of something, then building a single factor to measure that something might be a Herculean task. But such is the skill and dedication of my colleague and guest today, Laura Coomber, who's one of our biodiversity scientists and previously worked in the Peruvian Amazon, who alongside a number of our colleagues helped build out what's called the Biodiversity Risks Index Screen, which we designed to help investors reduce exposure to companies whose activities might negatively impact nature, such as deforestation or habitat loss and overexploitation of natural resources. The thought is, with the screen, one could build a bespoke index or an investable ETF, which will then allow them to meet regulatory or client or internal mandates to manage financial risks from biodiversity loss. Now, due to the relative newness of this screen, and a strong desire for me to understand how to sort through the complex web of biodiversity that underpins the way our entire planet functions, and therefore underpins the functioning of our businesses and our economy, and because I'm interested in how we found a creative way to build an understandable metric of measurement for the financial markets to deal with biodiversity risk, I decided I should call up Laura and ask her to take me through the research process, starting initially with how she and her colleagues went about measuring biodiversity.
So there's two central ways in which you can understand the relationship between biodiversity and the economy or individual companies. The first is impacts, which is the way in which companies drive the loss of nature. A really well-known example of this would be deforestation, is what everybody talks about. So, for example, companies that rely on soy or beef that are driving deforestation in the Amazon and therefore the loss of very important biodiversity. The second kind of angle is to think about dependencies, so the way in which companies are dependent on the services provided by nature. The most obvious example of this would be the agricultural sector, which is highly dependent on services provided by biodiversity.
I just want to quickly interject here and sort of take Laura's point and simplify it into a binary yes-no approach or categorization. There's nature-dependent sectors like agriculture or forestry or food and beverage companies that have direct operational reliance on ecosystem services. Agriculture needs pollinators, forestry needs trees, and let's say beer companies need potable water. Now, I could have said a lot of things there for food and beverage companies, but I think we all agree beer companies are the best of that sector. Anyway, service-based sectors, such as banks or insurers or tech companies, have a much lower direct dependency because of their operations not being physically tied to natural resources or ecosystem functions. Their exposure is instead indirect through financing or supply chain links to high dependency sectors.
I mean, you can the two ways that we considered this in an index screen was either a location-based approach or a sector-based approach. Because there are certain sectors that have an outsized impact on biodiversity that are responsible for a very significant proportion of the kind of business activities that are driving biodiversity loss.
Just to drive that point home, Location-based exposure is the share of a portfolio linked to companies operating in what's called biodiversity sensitive areas. That's a definition set by the WWF's biodiversity risk filter, whose data we use in the screen, and which tells us about 17 risk indicators at the asset level, like water availability, or timber provision, or soil condition, or water condition, or air condition, or ecosystem condition, or pollination, or forestry canopy, stuff like that. The company gets a high score if its assets are in areas where there is either resource stresses that are likely to impact them, or if they need to possibly build out better stewardship policies because they're located in an area of, let's just call it, pristine biodiversity, and their impact of that area may create some intense reputational problems that they then have to deal with. Now, in addition to the location-based exposure, there's the sector-based exposure, which is the share of a portfolio exposed to sectors known to have significant biodiversity impacts or dependencies, and which Lauren is going to explain more here in a second.
And then there's a lot of research and frameworks and analysis that really is able to link those sectors to biodiversity loss. And you can think again of agriculture or fisheries or mining as being some of those companies or some of those sectors and the companies within them that really drive biodiversity loss. So, I mean, what we wanted to achieve was a framework for a screen that could use readily available, trusted data and an easily understandable framework and methodological approach that just kind of was simple and identified essentially what you might call the worst offenders, the biggest actors in terms of biodiversity loss, so that you can exclude those from within a portfolio or any other kind of setting.
And so basically what Lauren and co did is they took these exposures, the location and the sector exposure, and said, okay, this sectors and the companies in it have a very high impact to biodiversity, or high impact to biodiversity, let's say, and said, okay, those securities that have this high or very high impact, those are going to be tagged, and those are either going to be excluded or underweighted compared to their better performing peers who will be included or overweighted if they don't have a high impact on biodiversity. It kind of depends what you're going to use the screen for. You can exclude companies, or you're going to tilt your portfolio toward the better ones and away from the worse ones, whatever, it's up to you. Now that, to me, an initial blush, seemed pretty simplistic for assessing the web of everything that is biodiversity, just a yes-no sort of Boolean designation. Does that mean we're missing a lot when it comes to biodiversity risk? Is this too simple of an approach? Are we going to kind of lose the forest and the trees in this situation? I asked Laura.
I mean, it's a great question. It is a recognizably simple approach, but I think that simplicity is important for the first stab at creating something like this. So in the early days, we really struggled a lot with this question, kind of from an academic perspective, or where do we draw the line on nature risk and biodiversity? Because essentially the entire economy is connected to biodiversity. So how do you draw those boundaries and create a framework that makes sense? At the same time, when you talk about financial decision making and index data choices, it needs to be data that's really well trusted. So it needs to have a long history, it needs to have limited volatility, and it needs to be something that really you can really confidently use within an index framework. And so you need to combine the realities of the data availability alongside a methodology that really makes sense in terms of understanding biodiversity risk. So when you combine those two things, we have a methodology that clearly identifies what we want to remove in terms of high impact sectors, and we have data points that really make sense and could be combined in a logical way. And we've heard from clients already that they're a fan of this simple approach because it makes something that is inherently complicated easy to understand and easy to communicate.
Can you detail a bit as to what those data points are that you use to ensure the flag was able to accurately capture biodiversity impact? You mentioned that you have some data points that you use to capture risks that aren't shown in the location or sector exposure. What were those?
I mean, controversies are the easiest data points to understand. So companies operating within a certain sector that have a very clearly biodiversity related controversy, such as, mining exposure or plastic pollution and that kind of thing. So those are the most kind of well-known data points, but it's also revenue exposure to certain high impact commodities. So you can think about palm oil or what would be some other ones, soybeans, for example, those kind of commodities that we very well understand and that we have good data for, and that you can also set a kind of a threshold for in terms of how strict you want to be within a framework. So you can say 10% or 20% or whatever is how, in terms of how strict you want to be.
Threshold, as in the sort of exposure you allow yourself in that sector, no more than 10% or something like that for a very high impact company. And controversies, by the way, are our metric that flags companies for their alleged involvement in acts that might carry financially material reputational risks. The on the ground, publicly reported type of acts, those are the controversies. Anyway, I think an important thing to remember, and the annoying caveat to remember with all this, that I believe many who are following the space are already aware of, is that when we build a financial model that measures some sort of externality such as biodiversity, we not only need to convince our clients to get on board, but we need to ensure our clients can convince their clients or plan participants, depending on what sort of person wants a screen. They have to convince those individuals that this approach will appropriately account for such complexity as biodiversity. If you get too complex in the initial go, you're in danger of scaring off, let's say, asset owners who are working with investment teams to manage a lot of people's retirement funds, for example, and don't want to leap into something that only a PhD in biology would understand. Because if it fails, and it's not easily explained by this investment team to the plan participants, well, you could be in quite a pickle. But once the simple approach is understood and validated with historical data and bought into, you can then move to a more complex approach because everyone says, okay, we agree that biodiversity is important, it's material, let's build on this, which is actually something Laura and co are already doing.
So the next big frontier is really location-based information, so our geospatial asset intelligence data. So the value of location-based information for biodiversity is huge. Like we really need to understand how the context of a company's operation within the biodiversity context.
So to be specific there, what you're saying is you want to move on from just looking at whether a company's manufacturing facility is located in a high risk area as defined by biodiversity and move on from giving it a yes/no flag and build a product that actually looks into the facility that the company operates in that area and how that facility is literally impacting biodiversity and thus the company's revenues. Is that it?
I think it depends on the kind of risk data that you're using or what you're trying to understand, right? So one of the major ways that we're working with location-based information is with the WWF biodiversity risk filter information, which was just launched today with new metrics, actually. But essentially, you combine asset level activity, like you're just saying, like a manufacturing operation potentially in the Amazon, with location-based information of how sensitive the surrounding area is and therefore potential risk exposure. And if you have all those metrics and information that you can aggregate at an issue level, you can potentially reduce the overall exposure of your portfolio by removing some of those metrics, some of those very high risk issuers like you just mentioned. Or you could reduce exposure or, decide on an appropriate level of exposure to that kind of a risk.
Yeah, moving from a situation where you're saying there's a mining company, a lot of its assets are obviously in metals and materials. Those metals and materials are in an area with a high amount of biodiversity risk. They're in some sort of forest. And so because of that, company X is likely has 5% or more of its operations that will be impacting and is dependent on biodiversity. So you're going to underweight that company in your portfolio. You want to move from that to say, we know that there's a manufacturing facility here. We know that the company has an asset level dependence on that manufacturing facility. And then we build in different biodiversity metrics that go into that and actually have a financially material score that comes from that. Is the greatest risk that you'll face is that that score just doesn't come to fruition? It's like too high. And so people say, well, that's great that you're able to measure this, but we've been using these metrics for a year, 2 years, and it doesn't seem like that mining company has had the kind of financial impact that you say it's going to be dealing with. And then that sort of breaks down the signal that the metric is dealing with. Is that what the biggest risk is of introducing these kind of more complex biodiversity metrics to the market are?
I would say so. I mean, we have quite a big team now working on this. And one of the major things we look at is, or we're trying to understand, is how you bring in the financial materiality of biodiversity risk. And how do you boil down all those really complicated models and understandings of diversity in local locations and WWF data and estimations? And how do you bring all of that into a simple signal that is reliable enough that a decision can be made in terms of investments. That's what you need to get to, and that's what takes a lot of work.
The pieces are actually already starting to fall into place. We announced today, as of this recording, the introduction of a revenue-based metric at the company level that links biodiversity risks directly to financial exposure. It's the first go at this question, and it's an expansion of those risk flags that are used to build the index that I talked about earlier. It expands them into what share of revenue is at risk due to biodiversity degradation. Their success as a broad tool can allow us to understand the complex web of biodiversity and how it can affect companies. But we have to sort of wait to see what these metrics show. We have to get more historical data, and then we will be able to assess its impact and then tweak it as better data becomes available, or as we better understand how companies are impacted by biodiversity degradation, or hopefully rehabilitation. And it's hard to stress the importance here of this sort of measurement because it's part of a growing understanding that we cannot just measure carbon emissions if we're to truly measure the impact that climate change has on our economy. We also have to look at how our economy impacts the fragile ecosystems that we all rely on to thrive and survive, and thus how that economy becomes more fragile as those systems get weirder and harder to predict. And that's it for the week. I'd like to thank Laura for talking to me about the news with a sustainability twist. I'd like to thank you for listening. If you like what you heard, don't forget to rate and review us and subscribe if you'd like to hear myself or any of the other co-hosts of Sustainability Now each week in your podcast channel. Thanks again, and talk to you soon.
The MSCI ESG Research podcast is provided by MSCI Inc. subsidiary, MSCI ESG Research LLC, a registered investment advisor, and the Investment Advisors Act of 1940, and this recording and data mentioned herein has not been submitted to, nor received approval from the United States Securities and Exchange Commission or any other regulatory body. The analysis discussed should not be taken as an indication or guarantee of any future performance, analysis, forecast, or prediction. The information contained in this recording is not for reproduction in whole or in part without prior written permission from MSCI ESG Research. None of the discussion or analysis put forth in this recording constitutes an offer to buy or sell or promotional recommendation of any security, financial instrument, or product or trading strategy. Further, none of the information is intended to constitute investment advice or recommendation to make or refrain from making any kind of investment decision and may not be relied on as such. The information provided here is as is, and the user of the information assumes the entire risk of any use it may make or permit to be made of the information. Thank you.